Hi, my name is Nur Natasha and I will present about Mr. DIY. So, Mr. DIY Group Berhad is a Malaysian's largest home improvement retailer operating in the fast-growing retail industry with over 1,400 stores across Malaysia and Brunei under various formats such as Mr. DIY, Mr. DIY Express, Mr. Toy, Mr. Dollar and Mr. DIY Plus. The retail sector grew by 5.5% in 2024, driven by strong consumer demand, digital adoption, and economic stability. Mr. DIY offers more than 10 product categories from hardware and household goods to personal care and toys, guided by its brand promise of always low price with 182.8 million transactions in financial year 2025. The company complements its physical presence with a growing e-commerce platform and strategic investments in lifestyle brands like KKV and The Calories. We'll present about liquidity ratio. So let's start with the current ratio. This ratio measures a company's ability to cover its short-term liabilities with its short-term assets, giving us insight into its liquidity. For 2023, Mr. DIY had a current ratio of 2.23, meaning that for every RM1 in liabilities, the company had RM2.23 in assets, which indicates a healthy liquidity position. Moving to 2024, this ratio improved to 2.38, showing an even better ability to cover its short-term obligations. This improvement suggests that the company has been doing well in managing its current assets and liabilities. However, a very high ratio could also mean that the company has ideal resources like excess cash or inventory that could be better utilized for generating profits. So, while the current ratio is strong, it's essential to keep an eye on efficiently using these resources. To continue improving, Mr. DIY should focus on working capital management, including inventory turnover, quicker collection of receivables, and paying suppliers on time. Next, let's look at the quick ratio. This ratio excludes inventory from current assets, focusing on the most liquid assets that can easily be converted into cash. In 2023, Mr. DIY had a quick ratio of 0.54, which is below the optimal level of 1.0. This means the company's liquidity positions was weak, as it could not cover its short-term obligations without relying on inventory. However, in 2024, the ratio improved to 0.68, which shows progress, though it's still below the ideal level. The increase indicates that Mr. DIY has been able to improve its liquidity by managing its liquid assets more efficiently. To further improve this ratio, Mr. DIY should consider optimizing inventory levels and accelerating the collection of receivables. This will help convert assets into cash more quickly and improve its liquidity status. Finally, let's talk about the cash ratio, which focuses purely on the company's cash position. It shows how well the company can meet its short-term obligations with available cash. In 2023, Mr. DIY had a cash ratio of 0.36, which means that the company had only RM0.36 in cash for every RM1 in liabilities. This suggests that the company was somewhat vulnerable to financial stress since it didn't have enough cash to cover its immediate liabilities. However, in 2024, the ratio improved slightly to 0.43, indicating that the company was in a better cash position, but it's still not enough to cover all liabilities. To further strengthen this ratio, Mr. DIY should work on improving cash management, reducing inventory, holding time, and speeding up receivables to increase its cash reserves.
Let's look at the gross profit margin performance of Mr. DIY. From financial year 2023 to 2024, the GPM saw a modest but meaningful increase from 45.85% to 45.85%. While this may seem like a small change, it highlights Mr. DIY's success in managing costs and adjusting prices effectively, especially in a challenging economic environment with inflation, with cautious consumer spending. One major contributor to this improvement is the company growing focus on white label products. This now accounts for over 48% of its portfolio compared to just 17% during its 2020 IPO. This in-house product help bypass distributor costs and offer higher margins. Additionally, over 65% of Mr. DIY's inventory was sourced from China in late 2024. This allowed the company to benefit from a strong ringgit against the USD and yuan, reducing procurement costs. To build on this momentum, the company should continue expanding its high margin product lines, invest in automating its supply chain, and improve inventory turnover at the store level. These steps can further enhance GPM and operationally efficiency, ensuring the resilience and long-term profitability as supported by Gosh and Vogue 2021 study. Now let's look at Mr. DIY net profit margin. While the company saw an increase in both revenue and net income, the NPM slightly declined from 12.86% in 2023 to 12.23% in 2024. This drop, thought not drastic, suggests that rising non-operating costs like administration, financing, and taxes are impacting the company ability to turn revenue into profit. A significant portion of Mr. DIY expenses, around 50% of sales, comes from rental and wage. To address this, the company has made a strategic investment in a 600,000 square foot automated warehouse aiming to reduce reliance on labor and improve logistical efficiency over the long term. So the company sourced over 65% of its product from China, which helped a lower procurement cost due to favorable exchange rates. However, this creates a dependency on foreign market. Diversifying into local suppliers could reduce exposure to currency fluctuation and improve supply chain stability. Looking ahead, Mr. DIY should align its operation with financial goals, as emphasized by Kaplan and Norton. Pricing strategy for its white label products, which now account for 48% of sales, must strike a balance between maintaining the always low prices brand and enhancing a profitability. As noted by Anisha Tanvir, achieving NPM growth requires a mix of lean cost structures, innovation, and strong customer value. Now let's look at Mr. DIY return on asset, which is ROA. So this ratio shows how efficiently the company use its asset to generate profit. In 2024, ROA declined from 50.79% to 14.96%. Even though net income increased slightly, the key reason for this drop is a faster increase in total asset, which grew from RM 3.55 million to 3.80 million. So this means Mr. DIY asset are based in expanding faster than its profit growth, indicating reduced efficiency in using assets. A major reason for this is a company ongoing investment, like its new 600,000 square foot automated warehouse which will take time to fully contribute to returns. To improve ROA, Mr. DIY needs to actively manage asset productivity. So this includes reviewing and possibility divesting underperforming assets, optimizing inventory turnover, and using data analytics to avoid overstaking. The company should also focus on increasing revenue per square foot through better use of technology like automated tracking and replenishment system. As Brigham and Houston suggest, firms with growing asset bases must monitor efficiency closely. Kaplan and Norton also emphasize that aligning asset use with strategy is the key to improve returns and long-term agility. Now let's take a look at Mr. DIY return on equity or ROE. This metric reflects how effectively the company is generating profit from its shareholder capital. In 2024, ROE declined slightly from 32.12% to 29.36%, even though the net income grew from RM 560,975 to RM 568,937. The main reason for this decline is a significant increase in shareholders' equity from 1.74 million ringgit to 1.93 million ringgit, mostly due to retained earnings and asset growth. While this increase in equity shows strong financial stability, it also signals that Mr. DIY hasn't yet optimized how it uses shareholder capital to drive returns. To address this, the company should focus on boosting profitability through its white label product strategy, which already accounts for over 48% of sales and offer high margin. So the company new 600,000 square foot automate warehouse also present in opportunity to reduce fixed costs and improve the scalability. Brigham and Houston emphasize that strategic capital reinvestment can drive ROE. So Mr. DIY should aim to balance dividends with reinvesting into high return areas such as digital platform, logistics, and private label expansion. Lastly, Mr. DIY can improve ROE by managing the three elements, which is profitability, asset efficiency, and financial leverage. Enhancing inventory turnover and operational efficiency per store are practical steps to ensure every ringgit of equity generates strong returns. In summary, to raise ROE, Mr. DIY must strategically manage its capital, increase margin, and fully utilize its expanding asset base.
Next, continue with efficiency ratio. Basically, efficiency ratio is to measure how well a company utilizes its resources to generate revenue and profit. Efficiency ratio consists of inventory turnover, fixed asset turnover, total asset turnover, and receivable turnover. Let's look one by one. Firstly is inventory turnover. It used to measure how effectively the firm uses inventory to generate sales, and the formula is cost of goods sold divided with inventory. Based on the calculation, Mr. DIY inventory turnover increased from 1.97 times in 2023 to 2.33 times in 2024. According to Melanie, improving inventory turnover through proper inventory control can reduce the cost of goods sold and help ensure that products are available to meet customer demand. According to Finance, Alex Go, Head of Marketing at Mr. DIY, the implementation of advanced robotic and tracking system within a new centralized warehouse set to serve 1,200 stores has significantly improved inventory management, order processing, and delivery operation. This strategy enhances stock movement, reducing lead times and increasing order accuracy. Secondly is fixed asset turnover that used to measure how well or efficiently the business uses fixed asset to generate sales, and the formula is sales divided with fixed asset. Based on the calculation, it has shown a marginal improvement for Mr. DIY from 5.27 times in 2023 to 5.28 times in 2034. According to Anisha Tenver, this can be achieved through the implementation of asset management software which provide insight into maintenance schedule, usage pattern and asset life cycle that avoid costly breakdowns that will hinder productivity. Mr. DIY implemented several initiatives such as invest in a 600,000 square feet fully automated warehouse with advanced robotic and tracking system, which streamline inventory movement, improve order processing speed, and maximize warehouse capacity that reduce operational redundancy, minimize handling time, and improve order fulfillment speed. Thirdly is total asset turnover that used to measure the firm's effectiveness in using all of its asset to generate sales, and the formula is sales divided with total asset. Based on the calculation above, total asset turnover declined slightly from 1.23 times in 2023 to 1.22 times in 2034. This is because increased depreciation and operating expenses associated with total asset grew at a faster pace than sales. Based on the article from Go Codes, improving the asset turnover ratio involves strategies in conducting regular audits and remove unused or underperforming asset from the balance sheet, and improve asset tracking through the digital system like barcodes or QR codes, which provide real-time visibility to location and condition, and optimizing the allocation of asset. Lastly is receivable turnover that is to measure a company's ability to effectively collect outstanding payment from the customer, and the formula credit sales divided with account receivable. Based on the calculation, it had dropped significantly from 40.88 times in 2023 to 31.33 times in 2024, indicating a slower collection of receivable. This because of weak credit policies, increased customer payment delays, or inadequate follow-up, and due to modest revenue growth combined with increased credit terms. According to Alexander, some ways to improve accounts receivable collections include using a consistent invoicing system to ensure customers know when to expect to be billed, and offering flexible payment options such as multiple methods and convenient online payment. An early payment discount can incentive prompt payment and help offset delays.
Hi, my name is Muhammad Sapini. Today I'm going to present the leverage ratio analysis of Mr. DIY Group Berhad, combining financial data for the years 2020 and 2024. This analysis focuses on three key leverage ratios: the debt ratio, the debt to equity ratio, and the time interest earned ratio. We see how this ratio changes, why they matters, and what tell us about the company financial strategy and risk management. Let's start with the debt ratio, which measure what proportion of the company's total asset is financed by the liabilities. In 2023, Mr. DIY's debt ratio was about 50.87%, which means just over half of its assets were funded by debt. By 2024, this ratio has improved slightly to 49.02%. This decrease suggests that company became a little bit less reliant on external debt, possibly by using retail earning to fund growth instead of new borrowing. For example, Mr. DIY invested in a new fully automated warehouse which add to their asset but didn't lead to a large increase in liabilities. According to Wareham and Houston, managing debt carefully and financial expansions through internal profit helps lower financial risk and improve long-term stability. Next, we have the debt to equity ratio, which shows how much the company relies on debt compared to shareholders' equity. In 2023, this ratio was around 1.03, meaning the company had roughly the same amount of debt as equity. In 2024, it's improved to 0.96, showing a stronger equity position compared to debt. These changes happen because Mr. DIY grew its equity faster than its liabilities, mainly through retaining profit instead of borrowing more. The company strategy include modernizing its supply chains and using technology to boost efficiency, which likely increase retained earnings. As noted by Wareham and Houston, a lower debt to equity ratio means the company is less financial risk and better positioned for sustainable growth. The third ratio is the time interest earned, or TIE. which show how many times the company's operating income can cover its annual interest expense. In 2023, Mr. DIY had a term interest earned of about 11.6 times, and although it's dropped slightly to 10.6 times in 2024, it still shows strong ability to make interest payment. This small decline was mainly due to a slightly higher finance cost as the company expanded, but Mr. DIY keep its operating profit stable by improving efficiency and automating its warehouse processes. According to Wyhan and Houston, keeping a high time interest earn ratio is important because it shows lenders and investors that the company can comfortably pay interest even if profits decrease.
Okay, now let's move to EPS analysis trend. Over the past 2 years, Mr. DIY has shown a steady upward trend in its earning per share EPS, reflecting consistent profitability. In 2023, the basic company recorded a basic EPS of 5.94 cent and a diluted EPS of 5.93 cent. This increased slightly in 2024 to 6.00 cents basic and 6.01 cent diluted, marking a modest growth of about 1.3%. The slower growth in 2024 was mainly due to relative flat profit performance, with profit attributed to shareholders rising marginally by 1.5% from RM 560. 7 million to RM 568.9 million, although revenue grew by 6.7%, higher operating and administrative costs reduced the impact of increased sales on net profit. Okay, additionally, EPS growth was slightly diluted by the issuing of approximately 16 million new shares from employee share option exercise. While the dilution was minor, around 0.17%, it still limited EPS growth, especially given the modest rise in the net earning. Despite these challenges, Mr. DIY maintained record high EPS level in 2024. However, to ensure stronger future EPS performance, the company must focus on improving cost control, boosting operational efficiency, and managing share issuance carefully. These steps will help Mr. DIY sustain profitability and competitiveness in an evolving retail environment. Okay, for a summary of Mr. DIY's financial performance 2023 and 2024, Mr. DIY demonstrates strong financial stability and growth between 2023 and 2024. Liquidity ratio, current, quick and cash improved, showing enhanced ability to meet short-term obligations, although exit liquidity may indicate underutilized asset. Profitability remains stable, while gross profit margin increased due to better cost control. Net profit margin, ROA and ROE slightly declined, impacted by higher costs and asset expansions. However, the company still achieved EPS growth, confirming its resilient business model. Efficiency ratio show mixed results. Inventory and assets and fixed assets turnover improved due to warehouse automations, but the total asset receivable turnover declined, indicating the need for better assets and credit management. Leverage decreased, with both the debt ratio and debt to equity ratio improving, signaling lower financial risk. The TIE ratio remains strong, showing that Mr. DIY can comfortably meet this interest obligation. Before conclusion, Mr. DIY is on a solid financial path, supported by operational efficiency and strategic investment. To sustain long-term growth, it should focus on improving assets utilization, cost efficiency, and equity returns, ensuring lasting value for shareholders in a competitive retail environment.